In this week's video, we'll review the latest charts and data to help us answer the question, what does history say about stock market upside and downside over the next decade? We'll be moving quickly, so feel free to use the pause button on your video player. We'll be providing a 2025 update to the secular trend thesis in this week's video. But before we do that, let's address a potentially concerning topic about today's market. You may be at home saying, there's no way stocks can perform well in the next decade because valuations are too high. That may turn out to be absolutely positively correct. However, article dated December 1st, 2009, U.S. stocks will plunge below March lows. That case was made in part because stocks were said to be expensive. We all know stocks have done quite well. This is the S&P 500 here in 2009. June 9th of 2009, a new era of muted growth and investment returns, often referred to at the time as the new normal. July 28, 2014, markets referred to as an equity bubble, and it's estimated that the 12-year S&P 500 total return will be roughly 0.6% per year. May of 2016, diminishing returns, why investors may need to lower their expectations. February of 2018, the firm forecast emerging stocks to return 1.5% above inflation, compared with a 4.7% real decline for U.S. large caps and a 3% real loss for U.S. small caps. They also stated that emerging market equities were likely to generate the best real returns over the next 7 years. From January of 2018, equities are priced to basically break even or produce a real return of approximately 0.5% over the coming decade. U.S. equities are poised for lackluster future returns. Thus, history tells us we could have said something similar in December of 2009, June of 2009, July of 2014, May of 2016, January of 2018, and February of 2018. And yet, with the benefit of hindsight, we know that it really didn't play out that way. Stocks have done extraordinarily well from this major low in March of 2009. Stocks have done well since 2016, and stocks have performed well since 2018. Simply telling us to keep an open mind about a wide range of outcomes, despite similar commentary in 2025. Where do we stand in 2025 relative to this title slide from 2019? We'll start with charts that we covered approximately 2 years ago that made the bullish case in June of 2023. And then we'll take these concepts and update the charts as of August of 2025. Clients and regular viewers know that harder markets are typically followed by easier markets. And we also know from past videos that the market was exhibiting extremely weak and rare trend characteristics in 1942 here, similar and extremely rare setup in trends in 1974, and again in 2009. The chart on your screen dates all the way back to 1933. That type of weakness on multiple time frames has only occurred 3 previous times. After the period of secular stagnation, orange box goes from 1933 into late 1949, you can see the market's trend starts to improve, and over here, we're in the secular trend. Similar situation. After the weakness in 1974, there's gradual improvement. Eventually move into the secular trend. The strength of the trend improves. And that improvement in the first blue box lasted roughly till the end of 1968, and weakness began early in 1969. Similar situation here. The strength lasted into the end of 1999. The market peaked in March of 2000, and the market's longer-term profile began to shift. From this low here in 1942, the market basically improved for 27 years into that peak in 1968. Similar situation here. From this rare look in 1974, the market's trend was strong for 26 years into the spring of the year 2000. If something similar happened in the current secular trend window, hypothetically, similar to this point here and this point here, the secular trend could last 26 to 27 years from this low in 2009, and thus it's within the realm of historical possibility that the secular trend could last until 2034 or 2035. We know that it's helpful to use technical analysis in bullish periods so we can compare the present day to prior bullish periods. It's also helpful to understand what bearish periods look like. You can see the red boxes look discernibly different relative to the blue boxes. And as we mentioned 2 years ago, it was fair to say in 2023 that the purple box here looks similar to this purple box and this purple box during the secular trend that lasted from 1950 into 1968, and the secular trend that lasted from 1982 into the year 2000. If you look at price action in the secular periods of stagnation, the orange boxes relative to the 50-month moving average, in green, the orange boxes are discernibly different relative to the secular trends. It's also noteworthy that we can gain additional insights by looking at those longer-term charts, since many market participants are looking at much shorter time frames, and with a high percentage of market participants only going out as far as the 200-day moving average. But once the 200-day is breached, longer-term charts can be very, very helpful relative to providing additional guideposts. Because in all three of these secular trend windows, the S&P 500 tended to make a stand at or near an upward sloping 50-month moving average, at or near an upward sloping 50-month moving average, at or near an upward sloping 50-month moving average, which is discernibly different from the secular periods of stagnation. And let's assume that valuations are a problem and the secular trend is ending in 2025. It's very important that we have a way to deal with that. And that was the topic of last week's video. You can Google this title here on your screen, where we ask and answer, what happens if we're wrong about all this? Some additional perspective for those that are skeptical about the present day stock market. It's worth watching this short clip from CNBC. You can find it by Googling this text here. One of the rational comments made in that video is that most of the capital expenditures in the present day are coming from the tech sector, and they're related to AI. And since these companies have so much cash on hand, their CapEx decisions are not really influenced by interest rates, possibly opening the door for the Fed to ease in the future, but that is to be determined. The S&P 500 is hovering around all-time highs, and there are still more bears than bulls. And historically, the U.S. has never had a bear market when confidence has been as low as it is today. Typically, when markets peak, this type of sentiment survey looks nothing like it does in August of 2025. And clients and regular viewers know we always ask, does the data that we have in front of us today align with or contradict the base case, which is that we're in a secular bull market that could last until 2035? As this chart shows, walking forward from 2019 into June of 2023, price action aligns with, rather than contradicts, the secular trend thesis. That was the conclusion in June of 2023. And what conclusions do we draw if we examine the same chart that we've been covering from 2023, but we do so in mid-August of 2025? Everything that we've talked about, harder markets are typically followed by easier markets. Market action and trend strength following the 1942 low, the 1974 low, and the 2009 low still have similar characteristics. We're still following the secular trend script based on the chart in front of you, which is dated August 14th, 2025. Thus, it might be a good time to update the answer to the question from a reference point perspective, and similar to the secular trend from 1950 into 1968 and the secular trend from 1982 to the year 2000. Where do we stand today? How deep are we into this secular bull relative to the two prior secular bulls? And historically, what does that say about potential upside from August of 2025? In the present day, we are similar to October of 1958 and March of 1991. And that's based on what happened following this major low, what happened following this major low, and what has transpired since this major low. Also noteworthy, walking forward from October of 1958, the additional gain in the S&P 500 before this peak in 1968 was a still impressive 115%. This tells us what the magnitude of the additional gain was. What about the duration? How much longer did the secular trend last? A little over a decade in this case. The secular trend peaked in November of 1968. How about the March 1991 case? What was the additional gain between March of 1991 and the S&P 500's peak in March of the year 2000? The answer, the S&P 500 tacked on an additional 310%. That's the magnitude, the duration, very similar to the 1958 case, a little over 9 years. If we add 10 years to 2025 hypothetically, or 9 years to 2025, we land hypothetically in 2034 or 2035. As with anything in life, especially anything that's difficult to achieve, we know that our goal is to try to navigate from a point A to a point B that could be several years down the road. Our goal is to try to navigate from a point A to a point B that could be several years down the road. And if we want to achieve that goal, it's extremely important that we have realistic expectations about how difficult it will be to navigate from point A to point B, or to navigate, in our case, from point A to a hypothetical point B that could be 9 to 10 years down the road. Was it easy to capture the additional 115% in this 10-year window? Was it easy to capture the additional 310% in this 9-year window? Based on human nature, the answer is no. There's no free lunch in the markets. We've updated all of the figures on your screen based on walking forward from October 1958 or March of 1991. How much volatility did we have to endure to make it to point B? How much volatility did we have to endure to make it to point B? From 1958 to 1968, there were 7 drawdowns in the S&P 500 greater than 6%. The average drawdown, pretty painful, 13.82%. The median drawdown, a hair over 10%. In the 1991 to March of 2000 window, there were 9 drawdowns greater than 6%. The average drawdown, a little under 10%. The median, a little under 9%. If we combine the 7 and 9 cases, average peak to trough drawdown on a closing basis, 11.5%. The median, 9.6%. And if you're going to build a model to help you navigate from a point A to a point B that could be several years down the road, it's important that you incorporate this data into your approach. It's helpful to know that 81% of these 16 drawdowns, the drawdown was less than 14%. In 88% of the cases, the drawdown was less than 20%. And 94% of those 16 cases, the S&P 500 drawdown was less than 23% on a closing basis. This knowledge, and the knowledge of how secular trends work, walking forward from this stage, can help us navigate from point A to a point B that could be several years down the road. We don't want to let excessive fear about 100% normal and to be expected drawdowns significantly impact our ability to participate in what the market is willing to give. And we also want to keep in mind, as we discussed last week, our approach better help us understand and deal with a situation where the secular trend doesn't make it anywhere near 2034 or 2035. The data that we had in hand in 2023 aligned with the secular trend thesis. And the fact that the S&P 500 made a stand earlier this year when the tariff news became less bad at or near an upward sloping 200-week moving average, that also aligned with, rather than contradicted, the base case that we've been discussing in this week's video. It's very, very easy to watch a video like this and start to think that our account balances are going to go up every day. We all know it doesn't work that way, even in a secular trend. Painful drawdowns are part of the equation. It's how you leverage the miracle of compounding. You make some, you give some back. You make some, you give some back. And psychologically, if we try to manage against our highest balance or our highest net worth, it's going to be very, very difficult to navigate between point A and point B. This is the hypothetical growth walking forward from 1958 to 1968 using S&P 500 index returns to illustrate basic concepts. This is the growth of $1 million portfolio walking forward from 1991 to the peak in March of 2000. Again, we're talking about the miracle of compounding. It doesn't matter if the starting point is 10,000, 100,000, or 1 million. The concepts are the same. We're talking about percentage changes here. So psychologically, it's important to note, if you wanted to have your portfolio grow from $1 million in 1958 hypothetically to over $2 million in 1968, or if you wanted your $1 million portfolio hypothetically to grow from the early 1990s to over 4 million hypothetically in the year 2000, it's helpful to see the swings in your balance. In the 1958 case, you go from 1 million to 1.2 and then disappointingly almost back to 1 million, then to 1.4. And then gut-wrenching because you move almost all the way back to 1 million. So our job in here would be to ask and answer. Does it still look like a secular trend? If the answer is yes, we try to stay with that long-term trend. Because eventually, if you did that, your $1 million hypothetically grew to 2.1 million on November 29th, 1968, representing a gain of over 100%. Similar situation here. It wasn't easy to go from $1 million in March of 1991, hypothetically, to over 4 million in March of 2000. Here, your portfolio grows from 1.7 million to 1.8, and then back to 1.6, and then from 1.6 to 2.1, and then back to 1.9. That's a lot of money if you're living it in the real world. It's painful to go, hypothetically, from 3.2 million to under 2.6 million. But that's what you have to do conceptually if you want to navigate between a point A and a point B that could be several years down the road. As we've noted many times, we don't want fear of drawdowns to prevent us from capturing what the market is willing to give. Those concepts are illustrated here. Historically, really good things tend to happen if you take a longer term perspective after significant drawdowns in the stock market. And given that the market is hovering around an all-time high today, in every historical case, if you were patient, eventually your balance was higher at some point in the future. But we also have to respect that periods of secular stagnation are also part of how markets operate in the real world. And we have to understand that our game plan in this window is different relative to this window. Our game plan in this window is different relative to this window. And this, asset allocation-wise, is different from how we approach this. And as we mentioned earlier, understanding the historical bounds of a secular trend and how they've operated in the past and how human beings have operated in the past can be very helpful. It was helpful earlier this year. It told us to keep an open mind about the market making a stand in this general area here. Even if it didn't make a stand, we would have learned something that was valuable. So we're not seeing anything in August of 2025 that contradicts the secular trend thesis. And as we covered in last week's video, we're not making any assumptions. If we enter a period of secular stagnation in the next 3 months, we have to be willing to reassess the probabilities and adjust our portfolios as needed, day by day. Let's talk a little bit about the strategy during a secular trend. What are we trying to accomplish from an asset allocation perspective? Let's use this chart here to learn something about human psychology and investing. This is 1990 down here. Upper right-hand corner of your screen is when the NASDAQ 100 peaked on March 9th of the year 2000. This is the NASDAQ 100 index relative to the S&P 500 index. And as you can see, periods that can last several months where you will hear things like market participants are rotating out of tech. The tech trade is over. Tech has been underperforming. This is a weekly chart with the 200-week moving average. And we know that secular uptrends have a tendency to make a stand at or near an upward sloping 200-week moving average. So we have to have realistic expectations about how we navigate between a point A in 1990 and a point B, hypothetically, in the year 2000. That could be several years down the road. We don't want to overtrade or over-tinker with our allocation. We want to try to stay with the long-term uptrends, the long-term leaders, the ETFs that have a higher probability of outperforming the S&P 500 over the next 9 to 10 years. And maintaining a focus on long-term trends and long-term relative trends can prevent us from getting spooked out of our positions when we see a headline that uses the term rotating or rotation. These are normal counter-trend moves within the context of an existing uptrend. And in this case, if you were patient and held on to the long-term leaders, it made a big difference. How much did the S&P 500 gain from point A, the end of 1989, to point B? And how much did the NASDAQ 100 gain? How much of an advantage was it to stick with the long-term leader as long as the chart in front of you said we're still in a long-term uptrend that favors the NASDAQ 100 over the S&P 500? And we could use a similar chart to look at any ETF or any stock relative to the S&P 500. The concepts are exactly the same. And understanding these concepts was really important to investors in this window. The S&P 500 did extraordinarily well, almost a 300% gain in this window, but the NASDAQ 100 just absolutely blew the doors off the S&P 500, gaining over 1,900%. Thus, when we're building our asset allocation and building our portfolios and our weightings, we look at 372 different ETFs from numerous perspectives, but we basically use these concepts. We want to own the positions that are in long-term uptrends relative to the S&P 500 or SPY or VU. And we want to try to ignore 100% normal and to be expected counter trend moves that occur within the context of any long-term uptrend. We want to try to capture the outperformance and the miracle of compounding between a point A and a point B that could be several years down the road. So this is the look we would want to embrace. The NASDAQ 100 relative to the S&P 500. The ratio is above an upward sloping 200-week moving average for the most part. And if we flip this chart upside down and looked at the S&P 500 during the same period relative to the NASDAQ 100, this is an example of the type of trend that we would want to avoid. This is the type of investment that we'd want to avoid. This is the type of counter trend move that we would want to try to ignore unless the chart in front of us changed or flipped. Then it's a different story. You trade the chart in front of you. Thus, let's take these concepts and port them to 2025 and ask a couple questions. Does this chart that begins in 2015 look like something we would want to invest in or something that we would want to avoid? Said another way, does this chart look more like this or more like this? The answer is this August 15th, 2025 chart looks a lot more like the type of chart that we would want to avoid. Thus, it might be helpful to ask and answer. What chart is this? This is small caps, IWM, relative to SPY. This is the chart in front of us. If this chart shifts in a material manner, we'll have to reassess the probabilities. So let's do it one more time in 2025. This is the type of chart that we want to embrace. This is the type of chart or investment that we would like to avoid. This is another ratio chart, ETF A divided by ETF B on August 15th, 2025. Looks a lot like the type of investment or chart that we would want to avoid. What is it? It's foreign stocks relative to the S&P 500, ACWX relative to SPY in the ETF world. In fact, since the tariff news became less bad, SPY over the last 89 to 90 trading days has been outperforming ACWX. And there's no question that the long-term trend has not flipped yet. It may flip very, very soon. It just hasn't flipped yet. And this type of chart doesn't align with what we're trying to accomplish within the context of an established and ongoing secular trend that potentially could last another 9 to 10 years. It's also noteworthy. The charts that we showed earlier in the video also dated August 14th. This short-term chart, this is a good-looking chart on this time frame. This chart, also a good-looking chart. We talked about this last week. This is your strong trend look. Lots of white space between the moving averages. The fastest moving average is on top. The slowest is on the bottom. Prices above the moving averages, and the slopes are up. Also an improving look. So multiple time frames, even shorter time frames, align with the concepts that we've covered in this week's video. Markets are extremely difficult, and that's why it's extremely important. If we're going to navigate between a point A and a point B that could be several years down the road, we have to maintain realistic expectations about how markets operate in the real world. And if we're going to adjust properly when the charts shift at some point in the future in a material manner, we all know it's extremely important that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice. and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.